Good evening and thank you for joining us on Capital Market. I'm Temple Ashaju. As we begin the show, feel free to track us on Twitter at Channels TV and at CTV Temple, the two key handles we use for this particular program. The equities and debt markets this week closed bullish as offshore investors make more demands across the various segments of the securities market, and that led to some kind of contraction in the yield curve and, of course, capital appreciation on stocks. But we'll get more details about that performance later on the show. Let's kick off now with some of the news that we have on our radar. And of course, the Executive Order number 7, signed on Friday by President Muhammadu Buhari, has received some commendations from analysts who applaud the initiative, saying that it will allow increased private sector participation in infrastructure funding and development in Nigeria. The managing director of Unlisted Securities, Mr. Ayodeji Ebo, says on his Twitter account that the new roads infrastructure and refurbishment investment tax credit scheme is a laudable initiative that should bridge the infrastructure gap in Nigeria. Mr. Ebo believes that the impact of the executive order could be felt within a year due to availability of funds. Now, the new order will see companies investing in some 19 eligible road projects totaling 794 kilometers across 11 states, with the first phase involving 6 private companies. And this weekend's heated political environment will be in sharp focus for Nigeria's financial markets next week, looking to wrap up the first month of the new year with some gains. Analysts fear that the 1.36% rally in the stock markets this week, which erases year-to-date losses, may have reversed on the news of the suspension and replacement of the embattled Chief Justice of Nigeria, Justice Walter Onoge, on Friday by President Muhammadu Buhari. The fixed income market also rallied during the week with positive outlook for next week's 150 billion naira bond flotation by the Debt Management Office. Analysts are now expressing worries that the inflows of funds from foreign portfolio investors may be dampened by the renewed concerns just 3 weeks to the general elections. And the West African country of Ghana is offering higher rates on its 3-month bills to attract local investors in order to support the currency. This is coming on the heels of concerns around capital flights orchestrated by offshore investors as central banks of emerging markets tighten monetary policies. Yields on treasury bills have been rising since the fourth quarter of 2018 as the cedi weakened 8.4% against the dollar last year. In spite of a stability reached on December the 19th, yields on 91-day treasury bills, which climbed to the highest in 9 months at the last sale on January the 18th, are seen rising further. The Ghana currency trades at about 4.995 to the US dollar. And now a bit of the stock markets, where equities closed positive for the second consecutive week, with the NSE All-Share Index gaining some 1.36% week on week to close at 31,426.63 points. The equity capitalization added 157 billion naira and settled at 11.719 trillion naira. This was largely driven by gains in the banking sector, which rose 6.46%, oil and gas, as well as the insurance segment in the market. That follows the buying interest that we saw in heavyweights, such as Access Bank, which rose the most by 16.07% this week, FBN Holdings, Guarantee Trust Bank, Mansard, which is an insurance firm, O&O on the oil and gas, and of course Total, which gained some 10%. And now a bit of the unlisted securities market. We saw USI closing this week lower by 1.33%, 744.38 as against 754.40 points that we saw in the preceding week. Market capitalization also ended lower than the 541.99 billion naira we had seen last week to close at 534.78 billion naira. In terms of volume, some 9.76 million units of shares were traded and was valued at 122.81 million naira in 41 deals. 10 out of the 39 securities tradable on that exchange were basically traded this week. And at the fixed income markets, we've got bonds this week, yesterday specifically, doing some 37 deals valued at 10.40 billion naira. And we have the 23rd of February 2028 security, the 2037s, and of course, all the tenors found on the mid and the long end of the curve, tradable more in terms of the bond markets on Friday. In terms of treasury bills, yesterday we saw some 245 deals valued at 128.87 billion naira. But we note that the Debt Management Office this week released the long-awaited Q1 2019 bond issuance calendar during the week, with planned issuance of some 400 billion naira coming higher by 14% year-on-year. Following the release of the calendar, buy sentiment tapered at the long end of the curve, with bond yields expanding by some 2 basis points week-on-week to 15.22% at the short end of the curve. And with the central bank's liquidity squeezed through open market operations sales of some 786.52 billion naira, average yields this week rose 33 basis points to 14.76%. Overall, average fixed income yield jumped some 17 basis points to 14.99%. And now, analysts at FSDH are projecting that the economic growth of 2.48% is what to expect in 2019, in spite of the downward reviews that we've seen from multilateral financial institutions like the International Monetary Fund and, of course, the World Bank. And that's to be seen in the Nigerian economy here. Well, the head of research at FSDH, Mr. Ayodele Akinwumi, tells the media at a session that the slow growth can be attributed to some inevitable double-digit inflation as well as other macroeconomic variables.
In terms of our local economy, we think that the GDP growth rate that we're expecting from 2018, we've discussed this before, is going to be in the region of 1.94 for 2018. Now, that's full year, but for 2019, we expect that the GDP growth rate will be 2.48. An improvement in agriculture, peace in the country, resolution of the crisis between the farmers and herdsmen should make agricultural activities to improve better this year. And the fact that the central bank, the current exchange rates, should also provide additional incentive for manufacturing companies to adopt backward integration in terms of providing sourcing raw material from the local market here, which will enable them to grow, to build capacity. A number of companies, large multinational companies that are operating in Nigeria, as much as possible, they are empowering farmers to ensure that they produce things that they are, that we are using in Nigeria here, that they are using for their production, manufacturing process, which becomes like a win-win for them, because it means that it will lower their cost, they reduce their exposure to foreign exchange, which we said that will likely deplete this year further, and then to enable them grow their profit. So we expect that GDP will be in the region of 2.48 this year, a little bit higher than what the World Bank is saying. However, 2.48, 2020, we expect to grow to about 3%. 3%, 2.48 are still lower than where we should be operating because of the level of our population growth rate. So government needs to provide stimulus to ensure that Nigerians grow beyond that level. We'll think that the growth rate may likely provide some opportunities for companies, banks to extend credits to the economy. We expect that in agro processing, there's going to be a lot of opportunities from that area. We'll expect that companies, as the government continues to de-risk the economy, then banks will have enough opportunity also to invest from them. Now, our inflation forecast in the medium term, we expect it to remain in double digits. Now, few things are going to drive our inflation forecast, and what we're going to have here is to say option A and option B. Now, like we mentioned earlier, the development in the international market, global economy, will exact inflationary pressure on Nigeria this year and next year. And the reaction, the policy implementation that we expect the federal government to adopt is to adjust prices, PMS price, and then pump price, and then electricity tariff, they need to go up. Now, this day, business day, about I think last week or thereabout, that this company in US that produces electric cars, Tesla, that is in Nigeria now, producing batteries that have high capacity to power homes and businesses. If care is not taken, that will encroach gradually into the market of the discos. And of course, government has given an arrangement now whereby you have willing buyers and willing sellers. That is to say, generate electricity, make it available for people, and you guys can agree on how much you can pay each other. And the price the people who are into that are charging is far higher than what NEC is giving regulated tariff in that sector. Now, if you look at the parameters with which the current tariff was developed, exchange rates were no longer in that level. Government is still subsidizing it. It's giving them money, the transmission, the generation, and all of those. You don't have to do that. Adjust the price to be cost reflective. Inflation rate has since moved. Gas price has since moved. Of course, gas price is priced in dollars. So if dollar was at 150 when it was developed, now at over 360 something naira to a dollar, it then means you can see the differential. So those guys don't have a tariff that is cost reflective, and they are businessmen. If they produce something that the cost is higher than the selling price, new investors will not come in, and the existing one, there will be a problem. And power is critical to development of any country. So we expect the federal government to adjust that tariff to enable it to reflect the cost of that producing that energy. And once that is done, inflation rates will go up. Federal government also see as options to say we're not going to increase it. But then it means that inflation will remain low. But overall, it's not beneficial to Nigeria economy because we will continue to have epileptic power supply. And like I mentioned earlier, we will continue to have a situation whereby our goods are not competitive in terms of cost with other countries because of high operating costs in Nigeria here. They need to reduce, we've discussed on extensively, adjust the price of PMS pump price, petrol, to ensure that to free up more money to the government to carry out their activities. And once that is done, the inflation rate will go up. So our inflation forecast this year, the average inflation forecast, and we think that these two issues will not likely happen before election, which is next month. Doesn't make sense to do that. But if the incumbent wins the election, we think they may likely do it immediately, which will be the best time for them to do before everybody settles down. But if another candidate apart from the incumbents wins the election, of course they don't have power to do that until they are sworn. So in our inflation forecast here, for this year, we have two scenarios. Number one, scenario one, that there is no adjustment to PMS price and there is no adjustment to electricity tariff. Scenario two, there are adjustments to those two prices, and then but whichever way you look at it, for this year, if there is an adjustment to those prices as we think it should be, it's going to remain in double digits.
And after the break, we'll explore the world of unlisted securities market more. Stay with us. Welcome back to Capital Markets, coming to you live on Channels Television, your news leader in Lagos, here, the financial capital of West Africa. Now, the NASD OTC Securities Exchange closed 2018 higher by 17% on the consolidation of interests from long-term investors and demands from private equity players. With the record performance, 2019 offers even more opportunities as the management of the OTC, led by the Chief Executive, Mr. Bola Ajomale, tells us about the plans to integrate mutual funds and exchange-traded products in the market this year.
We saw a lot of activity from private equity. We consolidated last year on our relationship with long-term investors. So quite a few investors were coming in were the longer-term investors rather than the shorter-term ones, which meant that after the recession, they now regained the confidence to come back into the market. So we saw some very big activity on these ones, and it continued through the year. So most of our trades, the larger trades that we had, or the bulk of our trades were actually very large deals as opposed to small ones. In addition, we also saw a takeover of a company by Allianz that came into the country and some other transactions that had been in the pipeline for a while. So those were the major drivers for our performance last year. This year we're expecting a bit more of the same. And in fact, we've concentrated a lot more on the private equity industry as well in opening up a new portal that services them and allows them to get to see the SMEs, our NASDAQ portal. So again, that's going to be a major driver of encouraging companies to grow and get used to the capital market. So our position was consolidated last year as filling a very vital gap in the capital market that brings companies closer to investors and widens the field for investors to choose from.
So how much were you able to achieve last year in terms of initiatives?
Well, we were able to open up two new portals actually, one for information and the other one for private equity investors. Those are the major initiatives that we drove at. We also drove at creating our own trading platform. So we opened up our own trading system as opposed to the leased one that we're using before. What that does is it encourages the fintech industry. It also encourages local industry as well, local talent as well. So fully homegrown, and that's been servicing us extremely well.
So in terms of outlook, how much are you expecting this year?
We saw, throughout last year, we saw a lot of activity. We ended the year at a 17% increase in our index. Part of what we're doing this year is actually harnessing that by creating some exchange-traded funds that can be traded and creating some more indexes. We're speaking with Standard & Poor's and some other data vendors who would actually put indexes together. So we expect that some indexes will come out of NASD this year that would allow people to actually consolidate on their gains and even make more gains. We made a 17% overall last year. We think that some securities last year made north of 80%, higher than 80% returns, even before you take dividends into account. We think we'll see quite a few more of those. Of course, some of them also lost value last year. We expect to see some of those increase as well. But in the net, we think there'll be an increase in our index again this year. An election year is an interesting period. I think it distracts people a bit until after the election. After the election, everyone goes back to business as usual. I think that a lot of the pent-up demand and a lot of the pent-up activity that has not been able to execute, that they won't be able to execute before the election, will come into play very quickly after the election. Hopefully, it will be a very quiet and a very decisive election, in which case we can get to a conclusion very quickly and we can move on with the economy. The economy is a continuum. So election year or not, there is a lot of business to be done, and I think that will be done this year as well.
But in terms of portfolio participation between the domestic and foreign investors, what is it like at this point in time?
We have, I would say, about a 70% domestic mix. The only thing, however, is that a lot of the domestic investors are also very large funds, and so they may have some foreign content in them. But I'd say a 70-30, domestic to international.
But do you really have any plans to attract more of these foreign investors?
Well, first and foremost at NASD, we're most interested in stability. We're interested in real growth. And so that's why we're encouraging the growth industry, the enterprise, the smaller enterprises to come into the market. Those are the ones we're seeking to grow on. We're not really set up to be a trader's market or where you get in and out on a regular basis. We're encouraging longer term investments. So we are very eager to have those kind of investments coming into the country, coming into the economy, regardless of whether they're local or international. We don't discriminate between one and the other, for as long as they're stable-ish funds, as opposed to speculative funds that tend to make the market more volatile.
We saw activities on quite a number of companies last year, but what are the plans you have to increase activities on some other companies that are less active now?
The most important thing is that companies generate their reports and generate their returns. Once they do generate returns and people can see how they're performing, whether for good or for bad, investors will be interested in either buying or selling. And so what we do is we encourage that companies, as much as possible, generate their returns as quickly as possible for each quarter. And once they do, people can see where they're headed and they can take an investment decision on them. I think right now a lot of investors are a bit shy of taking investment decisions directly on their own, and as a result they'd want to get into investment schemes, collective investment schemes. We've seen a lot of mutual funds. In fact, some of them are applying for listing at the moment on NASD, and we expect that quite a few more of them will come in and will grow this year. So that's probably the way investments are going to go, towards mutual funds and collective investment schemes, as opposed to people going on their own and buying one security on their own.
So what difference would that bring between what obtains at the NSE and of course at your platform?
Well, what it does is we're very heavily bunched in some securities and low on others. What it does is it would give investors the opportunity of choosing across a spectrum and leveling out the returns. So as I said, we made a 18% return last year. An investment scheme or mutual fund would have made that return. Even though it was taking a risk, it would make that kind of return.
That's the Chief Executive of the NASD OTC Securities Exchange. Well, before we go, some 150 billion naira will be on offer next week, January the 30th. And of course, that's by way of federal government first bond auction in 2019. It may just be time to talk to your asset managers, or better still, your brokers. And that's our show for this weekend. I'm Temple Ashaju. I'll see you next time.